in the infinite banking space, and if you're listening to this podcast, you're probably someone who's heard before the 401k sucks. You probably think, oh, I want to manage my investments. I want to control what I put my money into. I want to better understand what's going on there. And so I don't want a 401k. I just give money to the Wall Street and they control it. They manage it. They're making profits off of it. And maybe I get a match, but does it really actually help me much? Not really. And so is it a game changer? And is it going to actually give me the retirement I want? And the answer is probably not. It probably won't. And so, what are the alternative solutions? What are the alternative routes? And then that's why we preach that you need to control the banking in your life. If you can control the banking in your life, a lot of other problems go away.
Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? Today's episode, I am joined by the one and only Carson Herlean. Carson has been on the show before. He is actually younger than myself, okay? So he is a really good, seasoned entrepreneur. He's based out of California. He loves to surf. He definitely has that surfer vibe to him. If you're watching on YouTube, you can see that. And him and his wife, Anna, just had their first baby about 9 months ago or so. It was August or September of 2025. So they got a cute little fam going on over there. And Carson is in the real estate world. So he does some fix and flips. He has some buy and hold properties. And most importantly, he funnels all of the money before he goes and makes those transactions on real estate. It goes through his whole life policies first, his capitalized whole life, his infinite banking system. So Carson, why he's so unique is he's kind of like myself, where he's got the parents who are entrepreneurs, and his dad, Greg Herlean, owns a company called Horizon Trust. And Horizon Trust, they are a self-directed IRA company. And so what they'll do is they will help some of our people or other folks who have old 401ks and transfer them over into a self-directed account so that now they can go and do their investing with. They can actually self-direct those funds into the different investments that they're interested in. So, the whole episode title here today is, hey, why is your 401k your biggest enemy, or can it be your biggest enemy? And, I'm not here to crap on the 401k, seriously. I mean, it has a purpose, it has a place. There was a reason that Ted Benna in our government created that plan to help the American public save for retirement, so we're not working until we're 85 plus years old. But there are some downfalls just because of government intervention. This plan is not doing what it was intended for it to do. Okay, and actually there's a book called the 501k plan if you want a resource. 501k, it's written by the inventor of the 401k, Ted Benna, and he talks all about this 501k plan. And here's a short snippet, the Cliff Notes version. You know what a 501k is? A whole life insurance policy designed for high immediate cash value. Oh, AKA the infinite banking concept pioneered by Mr. R. Nelson Nash. And remember, y'all, these people aren't the inventors, or I should say Nelson Nash. He was not the inventor of the infinite banking concept. Whole life insurance has been around for a long time. Matter of fact, hey, shout out just real quick little plug. Thursdays, I go live on Money Mornings with Hannah on this YouTube channel. You can also catch it on my Facebook page or my Instagram page as well. But last week, I literally was at an event up in Philadelphia for one of the insurance companies, and one of the attorneys at the insurance company posed the question of, when did the concept of whole life insurance come about? And in my mind, I'm thinking, well, all right, in the United States, it came about really when the slaves were here, because slave owners would hold policies on their slaves. But actually it goes way deeper than that, just from our country. Back in the Romans, they were using this for burial expenses. Burial, whatever. Grammar is not my favorite subject. Failed grammar. But so life insurance has been around for a long time. The concept of life insurance has been here for a long, long time. It just has never been taught about the living benefits of life insurance. We're always taught about the death benefit protection of life insurance, which, yes, is very important. In my opinion, it's the only insurance that's actually guaranteed to ever happen. But life insurance itself goes way, way back to 100 BC, is what I've learned. But what we're talking about is the living benefits of the cash value that I can use from this whole life insurance policy with a mutually owned company that pays dividends. So that's what, as y'all know, my listeners at the Money Multiplier, y'all know that that's what we do over here, is specializing is that cardiologist when it comes to the infinite banking concept. But Carson has some good insights, and that's why I wanted him to take on this topic of the 401k, because I know it's mainstream ideas, mainstream concepts of, hey, go find a good corporate job, climb the corporate ladder, keep getting your raises, keep getting your bonuses, max out the 401k, find a good company that will match you X amount of percentage within that 401k, take that free money, if you will. But to me, the principles of money, it all comes down to the definition of money. Money is nothing more than just a means of exchange. And to me, if I put it into the concept that money is nothing more than a means of exchange, so money equals food, food equals money, money equals car, car equals money, why would I go buy myself a house or a car and then wait 25, 35 years into the future to drive the car and move into the house? That would be kind of stupid, kind of ridiculous, a little crazy, would it not be? But yet, people are doing that with their money. But you told me the definition of money is nothing more than just a means of exchange. So why are we doing things with money that we would never do with things that money buys? You see what I'm saying? And then also, if you guys have seen my presentation, when I teach this infinite banking concept, I start to pose questions to y'all of, well, okay, who controls that account? Is it you or somebody else? It's somebody else. Is it going to go up and down? Yeah, it's going to go up and down. In my opinion, it's an investment. It is an investment. That's one thing that they fail to teach us about, is that this 401k is literally an investment. My definition of an investment is it involves risk. It can go up in value and it can go down and lose value. There's some risk there. And that's what's so different about this concept that today I'm feeling a little peeved, to be quite honest with you. There's a few things going on in my life, but number one, I couldn't nap today. I never nap, but like today, I wanted a nap, okay? I was like up and down all night. And they're doing work on my roof right now, and literally right above my bed, because I'm on the top floor, right above my bed. All the all the sawing up there, it's annoying. But also, I'm a little annoyed, and I was peeved at some of even the people I've been talking to and my mentors even. I'm like, y'all, you guys don't need to have an illustration to show and share this concept. Take it back to the simplicity of what Nelson teaches us, which is you got to rethink your thinking. It is so different. I know. It's so different to what the masses behave and what mainstream media and mainstream education is teaching us. But I'm telling you, it is so stupid simple that sometimes y'all just want to overcomplicate this because you're like, oh my gosh, it's so stupid simple. There's got to be a catch to this. I mean, hey, my biggest advice is just dip your toe in, see what this world's all about, start a policy, start it small, do $100 a month if you really want to, right? You get to decide the premium that you want to deposit into your policy. But just really be open minded as you go into this whole world and this concept because I'm telling you, it's game changing when you really start to understand how money operates and what the wealthy have been doing all of these years, keeping the money within the family and passing it down generation after generation. I mean, it's truly life changing. I can say that from sitting here, second generation, starting my first policy at 18, getting into real estate investing at 20, and then becoming a millionaire by the time I was 24. Now I'm 26, I'll be 27 in August, and it's just been, I don't know, I just wish a lot. I'm like racking my brain. I'm like, why don't people think the same way I think? But that's so, I can't think like that. I know people got their own brains and their own experiences, their own wisdom that has gotten them up to this point in their life. And even myself, I got more to learn. I'm still a young girl just trying to figure it out over here. Oh, and especially with just what's all going on in our country, but we don't got to talk about that right now. That's why y'all are tuning in to my podcast to get your minds off of that shit. But anywho, so I want you to think for yourself and question, is what I always say. Tune into Carson's thoughts and really just hear what he's saying about the 401k. Think about who's controlling your money. Where are you leaving it stored at? Do you have access to that money? Because honestly, a lot of y'all have that money that you're putting away into those qualified accounts, yet you need the money today just for survival because you have debts, you got expenses, you got college tuition, you got taxes you got to pay. So my biggest belief and just something that I really want to leave here, my legacy on this planet, is I don't want y'all to feel like your money has to dictate how you spend your time, where you spend your time, or whom you're spending it with. That's my biggest just driving factor of why I do what I do. But all right, I'm kind of on my soapbox now, so I'll shut up. I'm going to let Carson take this over and stick around to the end. If you got questions for me, you can always reach out to me, podcast@themoneymultiplier.com. And don't forget to hit the like button, subscribe, and leave a comment down below if you have some other topics you want me to get into. All right, Carson, take it over.
Hello. Welcome, everybody, to the Money Multiplier podcast. This is Carson Herlean. I'm a guest host today. Hannah Kessler, everyone's favorite podcast host, reached out to me and said, "Hey, I'd like for you to talk about 401ks on our podcast. You've spent a lot of time around that field. You understand the history of retirement, and we'd love for you to talk about the 401k and how it relates to the infinite banking concept." And so today, that's what I'm going to do. I'm super excited and honored to be on this podcast. So all of you listening, we love and appreciate all of you. Just so you all know, my name's Carson Herlean. I'm based out of Southern California, and I'm on the Money Multiplier team. I've been with the Money Multiplier for the last 4 years or so. I think this almost five, a good amount of time, and I've been obviously learning from Hannah this whole time. We've kind of we're the two, I guess you could say, young people on our entire team out there teaching the infinite banking concept. And so we really relate and are able to kind of bounce ideas off one another and share this stuff to a lot of the younger generation that, really struggles with financial ideas. Now, however, we love everyone else. Obviously, we work with mainly people in their 50s and 60s, teaching these wealth building strategies to those who really need it. But we just love being in this space and hope that we can provide some education for you guys today. And so the topic again is the 401k. And so a couple of things come to mind when I first started thinking about what I'm going to talk about in this episode today. One, in the infinite banking space, and if you're listening to this podcast, you're probably someone who's heard before the 401k sucks. You probably think, oh, I want to manage my investments. I want to control what I put my money into. I want to better understand what's going on there. And so I don't want a 401k. I just give money to the Wall Street and they control it. They manage it. They're making profits off of it. And maybe I get a match, but does it really actually help me much? Not really. And so is it a game changer? And is it going to actually give me the retirement I want? And the answer is probably not. It probably won't. And so, what are the alternative solutions? What are the alternative routes? And then that's why we preach that you need to control the banking in your life. If you can control the banking in your life, a lot of other problems go away. And so today I want to talk a little bit about that. And so I like to start with talking about this with a little analogy. I call it the mountain analogy. So if you're listening to the podcast version, just kind of imagine this. But when we're climbing a mountain, or if we set a goal to go climb a mountain, let's use Mount Kilimanjaro for the example. If we're going to go climb this mountain, okay, then what are we going to do? We're probably going to want, if we're going to go climb Mount Kilimanjaro, we're going to want a guide or a Sherpa to help us on that trek. So let's say you're out, looking for Sherpas, interviewing different groups, and you find someone who says, you know what? I actually have 100% success rate of getting people to the top of the mountain. And you're thinking, oh, wow, that's amazing. I want to work with them. I want to be a part of that 100%. There's no way I fail if that's his numbers. But then he whispers in your ear, but I'm about a 50-50 shot at getting people back down. Now the whole perspective just changed, right? Is the goal really to get up the mountain, or is the goal to get up the mountain and back down the mountain safely, right? Think about that. So when it comes to retirement planning, it's the exact same thing. Most advisors just teach you to climb up the mountain, but retirement success depends on how you come down the mountain, not how high you get up. You can have a ton of money saved up. Does that mean that that money you've built up or the investments you've done actually translate to real income that'll last the rest of your life when you're coming down this mountain, essentially? No. Sometimes it doesn't. So we need to be preparing for this accumulation phase of our life and the distribution phase of our life when we're pulling income from our assets to live off of. And we can't just depend on Social Security to bail us out. Social Security is, I mean, to put it bluntly, I don't know where it's going to go in the next few years. It might disappear, might be gone, might be here, might be way less, might be who knows what the government's going to do with Social Security. So you can't depend on Social Security. And so, kind of how the history of retirement came was that was it. There was pensions and Social, well, not even Social Security, pensions for a very long time. Starting from about the 1920s to about the 1970s or so, pensions were the thing. You'd work for the same company for 40 years. They'd give you, income for the last 5, 10 years of your life, and you'd be done. Like that, you'd pass away. That was it. That was retirement. No one could fathom the idea of retiring longer than 5, 10 years. Then the 401k came out in the 70s. And the idea of the 401k was, well, now you can get access to your own investments. You can invest and get a match with the company. And from the 1970s to the 1990s, it actually crushed it. The market was averaging 15% a year during that 20-year period. So the 401k system looked like it really was going to work. But then 2000 happened. The bubble crashed. The bubble burst, I should say. Market crashed. Then what? Well, investors had never seen something like that before in their 401ks. And so they said, oh, well, let's see how this plays out. They waited a couple of years and the market actually rebounded. And so financial advisors went back to just saying, oh, whenever the market crashes, it'll just rebound. So who cares? We just got to keep investing more and more, keep climbing up the mountain. But again, they're just trying to accumulate assets. They're not talking about how to prepare for retirement and actually produce the income in retirement that you need. They're just climbing up the mountain. They're not coming back down. They're not preparing on the way up for the descent also. Because if you're climbing Mount Kilimanjaro, you're going to pack your bag differently if you're climbing up and climbing back down. There might be multiple days longer of climbing because you're coming back down afterwards. But if you're just climbing up, you're going to pack differently. Right. And so we need to pack our retirement assets differently if we're planning for the descent along with the accumulation. And so just this 401k system, again, they kind of thought it worked. It was all an experiment, though. It wasn't real. It wasn't actual planning. People who had just used the 401k solely for their retirement planning, they're just now retiring. People in the 70s who started this, 80s who started the 401k system, they're just, again, now retiring the past 10 years or so. And it's not working. It doesn't work. And so we need to ask ourselves, what are some other solutions? What can we do to actually produce the income we need in retirement? And so there's multiple ways we can go off of this. But for me, I look at the enemy of retirement being volatility. Okay. Market volatility is what destroys your retirement. Okay? What I mean by that is when you're accumulating assets, yeah, if the market crashes, it'll rebound, you're fine, technically. It'll still average the same amount over time and it'll still grow, whatever, right? But once you retire, the day you retire, you can't have volatility. What if the year you retire, the market crashes? Your entire asset dropped by half, all your assets. Then what? Then you also need to pull income from your assets to live. Now your account's almost down 60, 70% in the first year of retirement. You're gonna have to go back to work within 5 years. And so when you're staring at retirement, you're looking right at it, it's about to happen. Another analogy I like to use when talking about retirement is if you were skydiving and you were about to jump, and the guy whispered in your ear, "Yeah, we have about a 90% chance of making this and landing safely." Again, you wouldn't jump. Your whole life depended on this jump, and you have a 90% chance of succeeding. Maybe that's good. Maybe that's pretty strong. You probably will survive. But still, a 10% chance you don't. You're not going to jump. Retirement again is the same way. If we have a 90% chance of the money lasting our whole retirement, but a 10% chance it doesn't, we're not prepared. That's why people who are in their 70s and 80s have to go back to work, have to change their lifestyle, have to downsize. You know how hard that is to do? You know how hard it is to get back in the workforce when you're 80 after being out for 15, 20 years? It's impossible. You know how hard it is to have an income of X amount per year and then hit 80, you have to drop it in half when inflation's increasing prices of things? It's impossible. You would not be able to do it. So, why are we preparing, putting all our eggs in that one basket of the 401k? It does not work. And maybe you'd think, oh, if I had $10 million in a 401k, it would work. Maybe, but I'll show you some math here. The actual rate of distribution you can pull from your assets in retirement is Wall Street's version of it is 4%. You may have heard the 4% rule in retirement. You can take 4% of your asset base, and that's the income you should comfortably be able to take to have a 90% success chance of not running out of money in retirement. Okay, that's the number. So if you had $1 million saved up, 4% of that every year is $40,000. So you should be able to take $40,000 every single year for the rest of your life once you retire from your $1 million asset base. And that's enough income where you won't run out of money, most likely over that 20, 30-year retirement period. Okay, that's what Wall Street will tell you and preach to you. And so they say, get up the mountain, climb as high as you can, buy this new product, invest in this new thing, do more in your 401k, get the matches, because the bigger we can get, that means the more income you can take in retirement based on that 4% rule. Well, first of all, how hard is it to build $1 million up? And how little income is 40,000? All right, that's not actually livable in today's world. You probably need more like $150,000 to actually survive in retirement. And $100,000, you would need to have $4 million in your entire 401k to take a 4% distribution rate of $100,000 a year. So how hard is that? That's not doable. Like that's very, very difficult for the average person to do. The reason that 4% rule came up, the reason the Wall Street uses 4% as the rule is because that you can't take more because market volatility. Market volatility kills your income in retirement. Market volatility, what does that mean? Well, three reasons market volatility is a problem. There's a difference between actual and average rate of return. Maybe you averaged 8% in your account every single year, but that doesn't mean you actually are growing 8% every single year because there's some years where you're up, some years where you're down. And so if you earned 100% in the first year and lost 50% in the second year, you technically have made $0. But the average rate of returns, what, 25% over those 2 years? So maybe you averaged a certain return, but the actual return was not what you expected. And the sequence of returns is also a big factor. That matters a lot as well. Because what if in the first 2 years of your retirement, the market crashes? Now you're screwed. But if the market doesn't crash for 15 years into retirement, then you should be fine. So the sequence you get those returns matters a lot more than what the actual returns are over time. And the third reason market volatility is such a big problem is because of the distributions you take or the withdrawals you take from your assets for income when the market's down. Imagine if your account's $1 million and you lose 10% in a year and pull 40 grand of income, your $1 million just dropped 14% in the first year. Like you have to get back to $1 million, you need to make 20% in the next year. That's not going to happen. And so down market, when the market's down and pulling, withdrawals from your asset base, when the market's down, will also destroy your assets and destroy your income over time. You'll run out of money. So this 4% rule the government or the Wall Street teaches, they have all that built into it. But that's still not enough income, guys. 40 grand on $1 million. The reason, again, it's so low is because of all those factors that contribute towards you having risk by pulling income from your assets. And so again, the 401k does not work. Now, what does work? Okay. What works for you to have the income you want and have a more consistent retirement income?
Hey, sorry to interrupt the episode here, but I want to take a quick break. If what you're hearing today has made you curious about infinite banking, how it works, I want you to go watch my free presentation. In it, I walk you through the same steps that my family took to pay off $984,000 of debt in 39 months and how we've been able to recycle and recapture every single dollar since then. This isn't theory. This is real. I mean, this is what the wealthy have been using over 200 years to keep the money within the family. This is literally where banks, conventional banks, store a boatload of their dollars at. And it's the same process that we've helped thousands of families across the country put into action. So go to themoneymultiplier.com/presentation and see for yourself how you can start taking control of your money today. All right, let's get back into the episode.
So here's where infinite banking gets a little bit interesting. What if you had an asset in retirement that was not associated to the stock market, not tied to your investments, not tied to the government, not tied to any outside force? What if it was guaranteed to keep your principal safe always and guaranteed to be liquid at all times? Well, if there was an account like that, maybe we could build up all our 401ks and all our investments and have a small side pot of this asset that's safe so that whenever I needed to pull income from my assets, I would just pull from my 401ks, or retirement accounts. But if the markets were down and my accounts were down in a given year, what if I had another account I could pull income from that wouldn't affect my assets? That way they could rebound and catch back up, and now I'm not destroying them also while the market's down. This is what we call a buffer asset. We use a whole life insurance policy that's specially designed, the exact same policy that we set up to do infinite banking. We also use in retirement as a buffer asset, as a place to pull income from in retirement. So, yes, the 401k does not work when it's alone. But if you have a buffer asset in tandem to your 401k or your real estate or your crypto or whatever investments you choose, now you have a place to pull income from when the market's down. Now, and obviously this is a quick podcast episode, so if you really want the math behind all this, we can email you all the white papers and research we've done to explain this. But typically, you can either two results come. If you have a buffer asset and you can buffer income 4 or 5 times when you're in retirement, because the market might be down 4 or 5 times over your 20 or 30-year period of retirement. If you had an asset to pull money from during those years, that was not your growth accounts. Again, to let your growth accounts recover when the market's down. Okay. That typically allows you to either one, double the length of time you can retire with the same income, or double the income you can take per year. So now instead of taking 4% as the distribution rate of your assets, you can take 8%. So now it's a lot more achievable. Now, if you have $1 million saved up for retirement, you can now take 80 grand a year the rest of your life. And you don't need to take 40, you can take 80. You can double your income by just having a buffer asset to pull income from. So that your assets can recover. And then if they continue to grow, they should just keep excelling. And that way that's why you can take more income. So the point of today is not to give you the exact numbers, the exact step-by-step plan of how this all works, because obviously this would really need to be a one-on-one conversation with you to teach you the strategy and show you how to implement this. But all of you listening probably know the infinite banking concept, probably incorporate the infinite banking concept. So guess what additional thing your policy can do that maybe you haven't learned yet? It can be a buffer asset to your 401ks and to your retirement accounts. So when the market's down, if your policy is now fully refilled by the time you retire, you can now pull income from that as well. And now this can increase the amount of income you can take in retirement. How freaking cool is that, guys? Probably something you've never heard of before. But infinite banking is a fantastic strategy because now, while you're working, while you're making money, while you're saving, while you're making investments, all those things can go through your bank, building up this policy asset. That doesn't mean you're going to stop investing in other places. You're still going to go buy assets. You're still going to invest. Some are still going to do 401ks. And that's great. You need to invest in those kind of things. Because life insurance alone is not going to build up enough to be your whole retirement. But if you can do all those things while you're working, then when you retire, you have a policy now that's built up, grown for all these years, and all these investments you've been able to build. Now you have the perfect combination of assets to retire and have the most amount of income in retirement. So, I know I talked super fast. I know I went through like some super deep ideas there within like 15 minutes, like super fast. I get it. But research this idea, learn this strategy, meet with our team and ask how you can better utilize your policy or make sure your policy is set up to also be this for you in the future. So, to recap all of this, okay? You need to have an insurance policy, a whole life insurance policy set up to do banking and to help with income in retirement. Okay? The reason you want a policy to help with retirement is because when the markets are down, when the market's volatile, you need somewhere else to pull income from so your assets can recover. So we use a life insurance policy to do that. And by doing this, you actually can increase the amount of income you can take in retirement, increasing your lifestyle, elongating your retirement, and ensuring you have a better life. And so with our clients, we love to teach this strategy as an add-on to the infinite banking concept, as an add-on to just banking more efficiently. So if this strategy makes sense to you, you understand kind of what we're talking about, and you want to better utilize your policy and make sure your policy is set up to be able to do this for you also in the future, let us know. We want to help you. We want to teach you how this strategy can be used. Guys, whole life insurance that's specially designed, in my opinion, is the most versatile, important, foundational asset that you can ever have or invest in. Internalize that for a second. Whole life insurance is the most versatile, foundational asset you can ever have. Now, did I say it's better than a 401k? No. Did I say it's better than real estate? No. Different. But is it the best foundational savings vehicle, banking vehicle, versatile asset that there possibly is? Yes. Every single American in this country should be having a whole life policy they contribute towards. Whether they use it for banking or they use it just for the small, low fixed rate of return, the guarantee of principal, the death benefit, the ability to pull income long term, it can do all those things at once. Every single person needs to be incorporating this strategy. Whether they know fully about it or not, they need to start understanding. So if you find this valuable, you find that you or your family members or your friends or your community needs to learn this strategy, reach out to us. We want to help you set this up. We want to teach you guys how to do this. Our company does not charge anything for the consultations to teach you all this. Like this is all for free. Take advantage of this opportunity. Guys, I promise this will change your life. Doubling your income or doubling the time you can retire changes life, changes families. This is a very important matter that needs to be discussed and understood. I hope this sheds some more light on that today. We love and appreciate all of our followers and supporters. If you have questions, please reach out to me or our team. You can find me if you want to email me at carson@themoneymultiplier.com. I am here. I'm available. I want to help you guys. So questions that came up from this podcast, reach out to me. If you want some time to meet one-on-one, I'd love to do that for you. Again, Carson at themoneymultiplier.com. That's where you can find me. That's where you can reach out. I'd love to help. Just let me know you found me from this podcast, so I know kind of where you come from, what you saw or learned, and why you're reaching out. But anyway, appreciate you all. Have a good rest of your week. See you in the next one.
Thank you, Carson, for joining me today. So I hope that was insightful. If you have questions for me, y'all know how to reach me, podcast@themoneymultiplier.com. And I will be back next week. I have a fun little episode. It'll be my episode that I'm doing next week. And you can catch me as well this coming Thursday, 9 a.m. Eastern Time, Money Mornings with Hannah. Catch it live on the YouTube channels, or you can catch the replays on YouTube or wherever you stream your podcasts. But I appreciate y'all. Thanks for being here. Please ask me questions if you have them. You want to talk one-on-one, you know how to get in contact with me. Until next week, be well, do good, and I'll see you then, my friends. Bye, y'all. Hey, y'all, if you've made it this far, this is where most people stop, and that's why they continue to be stuck with their money. Continue on with your education. Click right here. It'll take you to the next video.